Synergy Income Fund today reported distributions of 44.22 cents per Synergy A-linked unit and 19.53 cents per Synergy B-linked unit. That's for the period from listing to the 30th of June 2012. It's a first condensed annual results. In its first condensed annual results, the company delivered 218% growth in assets. That's for the 6-month trading period. William Brooks, CEO of Synergy, and Chris Hart, Chief Investment Strategist at Investment Solutions, joining me out at the desk now to look at the numbers, and then of course we'll delve into other market news on the day with Chris. So William, thank you very much for joining us today. Congratulations of course on your first set of results after listing. Let's just firstly, I suppose, get a broad view. I mean, 218% growth in assets. You've talked about the higher portfolio occupancy. You've also talked about improving rental incomes. Just tell us about the period that was.
Thank you. We listed Synergy back in December of 2011 with only 2 shopping centres in the initial portfolio, but with a pipeline of opportunities that we had secured and that we were hoping to complete during the forward period. All of those acquisitions were completed, and in fact 2 other acquisitions on top of that were completed. So as at June, we increased the asset base to around 1.2 billion, and as at today, we've got an asset base of around 1.7 billion. So the period under review has been a period characterized by the consolidation of assets into the portfolio and the assembly of our core portfolio.
When it comes to vacancy levels, you say that it has improved somewhat to 4.6%. Tell us about, the type of clients that you have right now and what you've been doing to improve those levels.
Well, we actively manage our own portfolio directly. As at the beginning of the year, 1st of January, we had a vacancy level of around 5.8%. We've reduced that down to 4.6% in June with active leasing and active management. And in the last few months, we've reduced it further. It's now down to close to 4%. So it's all about managing those properties tightly and managing the leasing profile through relationships with national retailer groups.
When it comes to that expense income ratio sitting at 23.9%, give us an idea of where that is relative to your peers and what you hope that could be. What's the target there?
It's a very good ratio, and again reflective of a hands-on direct management approach. Also a relatively small portfolio of only 14 shopping centres, so it enables us to manage those assets more effectively. It's very much in line with our peer group and at the higher end. We hope to improve it a bit further, but it's fairly low already.
So Chris, let's bring you into the conversation right now. You're a company that targets medium-sized community and regional shopping centres. You operate in the retail space. What's your view on the property sector in general at this point?
Well, I think one of the big boosts that came was the interest rate cut that we got earlier this year, and that was a bonus. And I think there may well be more. The sector at the moment is. You're seeing asset managers withdraw from the sector a little bit because the sector's actually done very well and perceived maybe that it's run a little bit far from a pricing perspective. But it's an interesting sector. I have a funny feeling that the asset managers might be a bit premature. So you've got some asset managers sitting underweight the sector, and that's because of the outperformance. But my suspicion is that if we see further rate cuts, you may well see that the surge comes further, because retailing is quite strong at the moment in South Africa. It's not weak, and I think the further that we carry on with the retailing boom, as it were, you'll see that the shopping centres will do quite well. The concern, however, is how sustainable is this over the long term? How much is this just a factor of unsecured lending, for instance, filtering through into the retailing sector, for instance, and what happens when rates start to eventually go up? as they must do.
So there we go. How do you position your fund in light of those two scenarios? Because we still got interest rates low. You said that's been supportive. Sure. You're looking at areas in townships and rural areas. And then once we eventually do have this upturn in the cycle, what will that mean for your company's positioning?
Well, we are of the view that the space to be in is retail, and within retail, the subsector to focus on is the lower LSM component, the growing mass market within South Africa, where there's a structural undersupply of quality retail. So 76% of our portfolio, the majority of our 14 shopping centres, are located in those township and rural nodes where we believe there's a strong growth story that will be around for some time to come.
So, I mean, so basically you're well positioned. What do you hope your assets are going to be? You've got 1.73 billion rand in terms of your property assets. Do you have a target on that?
We've said to the market that we'd like to get to 3 to 5 billion in 3 to 5 years. So we will continue to aim for that target. I don't suspect we'll be able to continue growing at the rate that we've grown in the last 8 months. A lot of work on those acquisitions was done in the time preceding the listing. But we are very focused on new acquisitions. We're very focused on new developments with our partner Spar Group, and we're hopeful that we can build this portfolio further in the short term.
Well, William, thank you so much for joining us today. William Brook, the CEO of Synergy Income Fund. Still with us, Chris Hart from Investment Solutions, unpacking some of the other market news on the day. Chris, let's get your views on Avengers results there. You know, revenue up and operating profit down 64%.
This was the concern about the sector about 3-4 years ago. Can they maintain these margins? And the answer is coming out, they can't.
1.3% operating margin.
Exactly,
I mean,
that is razor thin. That's really just to keep the business ticking over more than anything else. And we saw, in terms of the peer space, Marion Roberts still bleeding cash at the moment. And so, you know, at the end of the day, one needs to ask at what point is this sector going to turn around? It's quite an important sector from a position of the government strategy to actually roll out infrastructure. But a lot of that money still has to come around, and the reason for that is...
Well, that's what they're saying. They're saying the game changer is going to be government's infrastructure drive. And what happens if it doesn't come or it's delayed?
Well, the key thing is when they say when that money comes through, the government's challenge is where we're going to get that money from. It's all very well to outlay...
That's what I was thinking today.
It's all very well to outlay grandiose schemes, but at the end of the day, we have a structural capital deficiency in the country. And that's where I think we've got a degree of frustration and a lack of understanding in that you know, why do we have that capital deficiency? And that's what's going to be the bottleneck for your construction companies. However, you don't want the sector to be bleeding to a point that they don't have institutional capacity to actually take the you know, new initiatives forward, you know, when it finally comes on stream, because people will move on, they'll change careers, etc. You can't keep people hanging on.
Yep, it is a big concern. Unfortunately, Chris, we're going to have to wrap it there.
Right.
A lot to talk about today, but we didn't get to you know, the likes of Discovery, in fact, falling back R1.73 on the back of its results. 14% rise there in full year earnings. So some disappointment coming through from the market.